Good morning, everyone. Very happy to see you here. My task today is to introduce you the Singapore saving bonds. I believe the media, especially the print media, has covered the topic quite extensively. In case you haven't read those reports, I'm here today to give you perhaps a little bit more details on the bonds, and more importantly, I'm going to give you, just like you, I'm one of the investors. I'll give you as objective a view as possible on this new innovative investment product. Okay, so this is what I'm going to cover. I will first give a detailed introduction of some of the salient points about the saving bonds. In short, we call it SSB. I'll talk about a little bit on the background, the features, the step-up interest, and the more operational issue of how to apply, and if you need your money back, how do you get back your money. And then I will go on to help you to compare, perhaps, with some other products like Singapore bonds, FDs, and retail corporate bonds, if you do buy them. Okay, background. The background is that I suppose the authority feel that currently we do have already a range of products that you can buy, but to some of you maybe they appear a little bit too complex, too complicated. So the authority felt the need to introduce a rather simple and also low cost. I will explain what do you mean by low cost in my slides later on. And also very importantly is a very safe way to invest, to help you to meet perhaps your long-term financial needs. It certainly complements your CPF and other investment options that you may already have engaged. Apart from deposits, you may have bought some funds, unit trusts, you may have bought some endowment plans. And for those who are more, should I say, prepared to take a little bit more risk, you may also buy shares. So with that, okay, now you can also consider Singapore saving bonds. Essentially, SSB is a kind of Singapore government securities. Okay, we already have Singapore government securities. Okay, we call it government bonds. Okay, traded in the market, but this is a special type of Singapore government security with features to make it more accessible and attractive saving option. So here are the very important main features of the saving bonds. So from your left to right, first, it is issued by the government, and very important point, it does not expose you to price risk if you want to redeem early. As you know, this bond is going to be 10 years, And let's say you invest today and 1 year later you decided, because you need your money back for some purposes, in the traditional government bonds, the government is not going to redeem the bond from you, and if you need your money back, you have to sell it in the secondary market. And when you sell it in secondary market, you'll be subject to price risk. The price of the traditional bonds, Singapore government bonds, may go up, but it can also go down lower than what you have paid for your bonds 1 year ago. So this is what I mean by price risk. But in the case of Singapore saving bond, it is a 10-year bond, but after 1 year you wanted your money back. You actually go to the government, not to the secondary market. Okay, the government promise they will give you back your principal 100%. Okay, no loss, of course no gain in terms of price, but you get your money back for sure. And then you will get the interest that they have promised when the time they issue the bonds. So for example, you must have read the announcement a couple of days ago for the first inaugural issue on 1st October. The first year interest is 0.96%. Okay, so when the government pay you back the bond after 1 year, because you want your money back, apart from the principal, you also get $96. Okay, if you invest in say 10,000. Okay, so this is very important point. So it's safe. Okay, call it risk-free, and because it is not traded in the secondary market, that's why it's non-transferable. Okay, long term is 10 year, and they pay you fixed return, so it is akin to fixed deposits, but fixed deposit doesn't give you the kind of long-term that you see, long-term investment that you see in SSB, and the interest rate is step up. I will introduce to you in a moment. And the return, because this is issued by government, the saving bond is issued by government, so it is only fair that you are also getting the same return as the traditional or conventional Singapore government bonds. And these returns are determined by the market, because conventional bonds, government bonds are traded in the market. Okay, so it's not up to the government to decide how much to pay you, but it is the market that decide how much is your step-up coupons. Okay, and lastly, very important feature. Personally, to me, this is most important feature. Is very flexible. Although you buy the bonds today for 10 years, but as I said earlier on when I explained the save feature, at any time you can get back your money. Okay, not necessarily 1 year later. You can, for whatever reason you want your money back anytime, you can get back your money with accrued interest in proportion to the period that you hold. Okay, and no risk to your principal, and no penalty. Okay, I will compare with FD later on in my slides. And this Singapore saving bonds is only open to the individual. Okay, any individual. Okay, not for corporation, not for companies, and it is also interest is also tax exempt. Let me go through very quickly the issuance program. This is important because just to address your perhaps you're worried that if you can't get these bonds on the 1st October, there will be plenty of opportunity for you to buy these bonds later on. So the authority has announced that starting from 1st October, every first business day of the month, they will issue the saving bonds. And for this year, it will be, so we have only 4 months left. So for the next 4 months, they will try to issue up to 4 billion. And as you learn from the announcement, the first issue, the authority planned to issue 1.2 billion. So for the next 5 years, the authority has promised that every first day of the month, there will be saving bonds issued. So no rush, no need. There is absolutely no rush, no need for you to rush for the bonds. And this is also an important feature. It is denominated in units of 500. Okay, so you can either buy 500, 1,000, 1,500, 2,000, and so on. But it started with just 500. So even if you are a very small saver, this is something that you can invest. There are some other some restriction on how much you can buy. I explained this already. Okay, and another important point is that currently you can only buy this with cash. Okay. For every single individual, for every single issue, like for example the coming 1st October issue, the maximum that you can get is 50,000 of these saving bonds, not more. Okay, so assuming you got your 50,000 saving bond on 1st October, can you still apply when the 1st November issue comes? You can. You still can apply, right? But in total, okay, let's say you are also successful in applying another 50,000 on 1st November, the second issue, and in total you have 100,000. The features here is that, after that you can no longer buy any more saving bonds. So I suppose the purpose is to try to spread among as many Singaporeans or as many individuals as possible. Okay, give everybody a chance to buy. Step up interest. The bond itself pay interest every 6 months, and the interest rate is going to step up over the tenure of these 10-year bonds. And at the time of issue, the interest rate for every one of the 10-year is determined. They are determined at the start. Okay, it cannot be changed. And the longer you hold, because it is step up, the longer you hold, when you average your return, it is going to be higher and higher. So let me just give you the example based on the recent announcement for the first issue on 1st October. So assuming you invest 1,000, okay, so as the announcement mentioned, the interest is 0.96%, and therefore in terms of dollar, you are getting 9.6 if you hold the saving bond till 1 year till 1 year later, right? If you hold until 1 year, you definitely get your $9.6 from the government. Now, if you continue to hold and do not redeem early, then in second year you get 1.09% per annum. So in terms of dollar, you get 10.9. So it's being stepped up. And then your average return from 0.96, now the average return for the 2 years that you hold the bond is 1.02%. And if you continue to hold until maturity, which is 10 years, that particular year, on the 10th year, you get 3.7%, much higher. In terms of dollar, you get $37. And if you work out the average, you'll be getting, for this 10-year investment, a return of 2.63%. Okay? So how are these step-up interests determined? As I mentioned, it is based on the conventional Singapore government securities yield that we see in the market. Okay, and for the saving bonds, for the 1st October issue, they take every business day in August what is the yield for 1 year, 2 year, 3 year, up to 10 year Singapore government bonds, and then take the average for each tenure. So, and that will be the reference rate for the government, for the Singapore saving bonds. So this is the whole 10-year step-up interest rate, and the second row is the average return. Okay. So why step up? I mentioned briefly to provide flexibility while ensuring that an individual effective return matches his or her investment period. I suppose most of us, when, let's say, when we first buy into this bond, some of you may not know how long you're going to hold this bond, right? But the special feature of these saving bonds give you the confidence that that doesn't matter. If you think the returns are attractive based on your risk appetite and so on, you can just invest in it, because at the time you want your money back, you are always assured of being paid the return commensurate with the period that you hold the bond. And the longer you hold, the higher your return. So you can decide to hold only for 2 years or 10 years. So you don't really have to worry whether at the time when you buy how long you're going to hold the bond. Okay? In that sense, because the return is commensurate with the period that you hold. Who can benefit? Retirees, because it is a very safe saving option to have predictable and predetermined return over the 10-year investment period. If you are risk averse. Young saver, because it started with only just $500. So it's a good instrument for you to encourage your kids to start saving, maybe you buy on their behalf, for example. Rainy day funds, okay, and even for very active investors, this can serve as a part of your diversified portfolio, okay, to balance the risk in your portfolio. Subsequent speaker will speak more on this. Okay, let me just go to some of the operational matters. So first of all, you must have a bank account, and you must also have a CDP account. And the CDP account, you must arrange for direct crediting service. Okay, in other words, the account must be linked to your bank account. Okay, so that when you apply, when you redeem, with this account and the credit service, you don't have to do anything. It's all automatic transfer of securities and funds. You must be 18 years old to apply CDP account, and useful for you to know that you need 10 working days. So if you haven't got one, go and apply, because you have to wait for 10 working days before the account is open for you. And actually, how you go about applying is that you have to apply through ATMs of the 3 local banking groups, or for the moment you can go to DBS or POSB internet banking to apply. And there will be a $2 application fee, just $2, and non-refundable. This is an application timeline. Let me just use the actual case at hand, which is the issue on 1st October. So all of you know that the announcement has been made on 1st September, a few days ago. And then immediately after the announcement, you can start applying at 6 p.m. on that very day. And throughout almost the whole month, throughout the whole month, you can apply. And the last application date will be on 25th, okay, by 9 p.m. And the very next day, which is on 28th, there will be allocation of the bonds, and you will be informed accordingly. And the next day, if you are not successful, the fund will be returned to you because of over-subscription. So this is going to be, this is what actually going to happen, okay, for this fund. In the case of over-subscription, okay, let me talk about over-subscription. Give you a very simple example here. For simplicity, let's say government issue only $10,000 of saving bond, and assuming we have total application of 18,000 in terms of dollar, and let's say this 18,000 application were put forward by this 4 person A, B, C, D, and this is their respective application amount. So if you add up together, it is 18,000. So as I mentioned, one of the important feature of this bond is that, okay, it wants to be spread to as many investors as possible. So let's see how it spread among these four investors. So because there are only four investors, so you can see for each of the first four rounds of allocation, they each will get $500. So round one, 2,000 is allocated evenly among the four investors. Round two, same thing. Round three, the same thing. Round four, the same thing. So each round is 2,000. 2,000 times 4, so you have 8,000 of saving bond being evenly, fairly allocated among the four individuals. I mentioned government in this example issue 10,000, so there is still 2,000. Okay? But what happened is in round 5, individual A only applied for 2,000, so he is no longer in the picture, right? So it's only person B, C, and D. Okay, so they continue to get allocated 500 each in round 5, and that is only 1,005. Okay, 1,005. So how much left? Only 500 left, because at the end of round 4, I mentioned the government still have 2,000 hasn't allocated of the bonds. So round 5 issued to these three individuals of 500 each. So it's 100. So it's 1,005. So you left 500. Okay. Now how do you round 6? How do you decide how to allocate the 500? The last 500. It is going to be by randomly selected. Okay. So in this example, I assume individual C get the last $500. The cutoff means the point before which the bonds are evenly allocated. There is no balloting. Okay, but after round 5, the last 500 is being kind of balloted, and C has got the last 500. So at the end of the day, A has got 2,000, B and D has got 2,005, and C get $500 more at 3,000. So this carry the important message that the way we allocate, or the way the scheme allocate, is try to spread out as many investors as possible. Okay, so you are successful. You get some of these saving bonds. So how do you redeem? At any time when you need your money back, again, you go through almost the same process as you apply. Okay, you go to the ATMs, you go to the internet, and also you can redeem in the multiples of 500. And because you are redeeming, so there's another small amount of $2 you need to pay for administrative costs. And the timeline, I didn't want to bore you with the timeline. It's almost the same as application. Okay. Okay. This is, I suppose, more important to you. Let's compare with the conventional Singapore government bonds or securities, the bank's FD, and retail corporate bonds if you do buy some of them. Let me just split it up and compare saving bonds with FDs. In my own personal view, the impact on the bank's FD, if any, is likely to be marginal for the following reason. Number one, it's a small amount, because even bank FD, my understanding is at least you have to come up with $1,000, $2,000 for fixed deposits. So this is really a much smaller amount. So it's not in direct competition, okay, for the small saver. And also because of the restriction with the purpose of spreading out the allocation, I mentioned earlier there is a limit per person, right, as to how much in total you can invest and hold the saving bond, which is $100,000. But for FD, there's no limit, okay? So in that sense, it's sort of capped. If there's any competition against FD, the cap the competition from the SSB. And this is a public information. You can go to MAS website. You can have these statistics about, in Singapore, the total bank, the non-bank deposit meaning people like you and I, or even corporation, when we put the money with a bank, we are considered non-bank. So non-bank deposit, there is a total amount of 540 billion, right? And as I mentioned earlier, for the rest of the 4 months, for the whole of this year, remaining 4 months, they only issue up to 4 billion, less than 1% of these bank deposits. So the impact, if any, is likely to be marginal. In fact, I will argue that the saving bond is very unique because of those features that I mentioned earlier. It is actually, it presents itself as a unique alternative, not alternative, but addition to what you can consider in other investment, okay, like FD. It complements the FD. Because it's combined features of bank FD, okay, it's not exactly FD because it is issued by government. It's a bit like FD because it pays fixed return, and like FD, it doesn't have the price risk that I mentioned earlier. Your principal is not at risk. And it is different from FD because when you buy saving bond, your risk is the government, right? Your risk is the government don't pay up. As compared to if you put in the bank deposits, your risk is that if the bank default, the bank can't pay you. So there are two different risks, okay? Although I must also, as an objective view, I must also tell you that if you put deposit with full bank, the 3 local banks are all full bank, and finance company, they are insured. Your deposit with this institution are insured up to an amount of 50,000. Okay, I mentioned this already, but not in the case of FD. If you redeem early, what happened? Let's say you put. I give you an example. Let's say you have 25,000 or 50,000. Okay, these days the bank give you promotional rates. If you have slightly bigger amount, instead of just 500, if you put 500 FD with a bank, I'm talking about average, you may get paid about 0.25, 0.3, 0.4%. But if you have, let's say, 50,000 and you put FD for 1 year, the bank may give you about 1.5, 1.6. That is what I call promotional rate because of larger amount. Now what happened? Let's say after 6 months, okay, for the bank FD you want your money back, but 6 months ago you tell the bank you are putting this 50,000 for 1 year. Okay, the bank tell you that, okay, I will pay you 1.6%. But 6 months has passed and now you want your money back because you need to use the money. Guess what the banks will pay you? Will the bank pay you 1.6%? No. I actually make a few phone calls to pretend that I want to put some FD with the banks. And they said if you take your money back at the end of 6 months, for your 1 year FD, they said I can pay you only about 0.3% for the 6 months. And the 0.3%, I later found out, is actually the 6-month FD rate, the non-promotional FD rate. And some bank may even pay you less. It depends. Okay, it depends the bank. Of course, there are competition, so there could be some alignment of how they decide on the penalty rate. Okay? But in the case of saving bond, you put as a 10-year bond, you buy the 10-year saving bond. After 6 months, you want to take your money back. How much interest do you get? You still get your 0.96% for 6 months. Okay? So that is a very important feature of the saving bonds. And because of that feature whereby you can redeem anytime you want, you don't have to worry if, let's say, interest rate is going up. Okay? Why? Because if interest rate is going up, you can just redeem the old saving bonds, take your money back, and apply the new saving bond. You enjoy the higher step-up rates. Right? Let me just compare saving bond with traditional government securities. Okay, as you know, both are issued by the government, so very safe. But I also gather that the retail participation in the conventional Singapore government security is low, possibly because of the following. Lack of familiarity of the SGS, how it works. It's a bit complicated, okay? And there is price risk, okay? In the case of the conventional government bonds that you see now in the markets, you have price risk. When you want to take your money back, how you take your money back? You have to sell your traditional conventional government bonds in the secondary market. Okay, let's say sell it to a bank, a dealer. Okay, and because of that, in a rising interest rate market condition, the price of the conventional government bonds will be lower. Okay, maybe even lower than the amount you paid for the bond. So there is a price risk. And as I said, who is buying and selling your traditional Singapore government bonds? Is the bank dealers. So you may lose in bid and ask, a bid and offer spread, and also brokerage fees. And that's the reason why the authority wanted to launch this relatively simple, okay, saving bonds. I think I explained this already. So when you buy the conventional government bonds, okay, assuming you receive X coupon, but if you need your money back before that, you are subject to price risk. You may not get your X % coupon, but SSB mirror the conventional Singapore government bonds return, but at the same time you don't have those risks that faced by the conventional Singapore government bonds. Okay, I've explained this. I only have about 1 minute. Let me just speed up a bit. So this is a comparison just to help you compare. I put the four type of assets together. In terms of minimum amount, as you can see again, SSB has got the lowest minimum amount. Of course, it has a cap of 100,000. The tenure, okay, this is 10 year. Okay, and you can see SGS can go up to 30 years. FD usually is up to 3 years, and corporate bonds can be anything between 3 to 7 years usually. Okay, and the yield. Okay, how do you decide the return on your SSB? As I said, they refer to the conventional government bonds. How about the conventional government bonds? On the primary issue, when the government first issued the bond, it is decided by auction. Okay, there is a group of primary dealers who bid for the Singapore government bonds, and then after issue, it is traded in the secondary market. Okay, so it is by and large determined by the market. FD, by and large, decided by the bank themselves, but obviously they are subject to competition. So in a way, it is also the market will influence how much they decide on their FD rates. And for corporate bonds, the price is decided by the issue managers, of course, in taking into account of the market condition, and is traded in the secondary market also by financial institution. And interest payment, you can read for yourself, semi-annual or annual. Usually it's semi-annual or annual. And this is our last slide. Remember, SSB, SGX are issued by the government. Okay. Tradable, SSB is not traded in the secondary market, but you can get your money back anytime directly from the government, if you so decide to take your money back. Whereas SGS is traded in the secondary market, you can't, before maturity, you can't go to the government and say, I want my money back. The only way to get your money back is to sell it in the secondary market. Okay, so that's why there's a price risk. FD is not tradable. Corporate bond is also tradable. Early redemption I mentioned already, so you can redeem anytime, is allowed. Not the Singapore government bonds. When I say redeem, meaning redeem it from the issuer. Okay. And if you redeem early from the bank, in terms of FD, I have explained to you, they will not be paying you the rate that they promised on the first day when you put the FD with the bank, because you didn't keep the FD up to the agreed maturity, and therefore they will pay you lower, or in some cases even there's no interest if it is shorter than 3 months, for example. Okay, and this is some important website and hotline that you can access to ask for further information. I thank you for your attention. Thank you.